In this video, I'm going to show you the 3 factors to work on to build $1 million portfolio, and then I'm going to break it down on how you can actually do it. Regardless of whether your goal is to have $1 million portfolio by the end of next year or by the end of your life, it ultimately comes down to the same 3 factors, which are TRM, time, return, money. How much time do you have for money to compound and grow? Return is how fast can you grow and double your money? And money is how much money can you invest? If you have $950,000 to start with, you already have a lot of money, which means you can get a very low return and still hit the $1 million portfolio in a short period of time. If you don't have $950,000 to start investing, that's okay. You can also focus here on improving your returns. The better your returns, the faster you can double your money, the faster you can get to the $1 million portfolio. You might have heard people say, if you start with 1 penny and you double that penny every single day, so you start with 1 penny today, 2 pennies tomorrow, 4 pennies the next day, after 30 days, you will have more than $10 million, which is the power of your return. But even if you are a horrible investor, you don't know how to get good returns, you don't have a ton of money to start, well, you can make up for that by having more time. Letting your money compound for more time, that way you can hit that $1 million portfolio. See, the way you build wealth is a combination of these 3 things, and let's break down now how this actually works. The stock market, more specifically the S&P 500, has grown by just over 10% a year on average over the last 100 years, which means the average market return is about 10% a year. So now let's have some fun. Let's play with some numbers, and then I'll show you how you can actually do this with your own portfolio. For the sake of this video, let's assume that you're not outperforming the market, you're just getting the returns of the market, which is about 10% a year, and let's assume that you can only invest $100 a month. If you can invest $100 a month, you get a 10% annual return on your money. You do this every single month. It's going to take you about 46 years to retire a millionaire. Now you might say, well, Jaspreet, I don't want to wait 46 years to become a millionaire. Well, you can work on this or you can work on this. You can work to get better returns, increasing your financial education, learning how to invest better, taking on some more risk, or you can work to invest some more money. Maybe you work to get a raise or a career change or get your finances in order, and now you can invest $500 a month. If you can invest $500 a month, you get the same 10% return. Now it's not going to take you 46 years to hit that $1 million investment portfolio. Now you will do it in about 30 years. If that's still too long, let's get a little bit more aggressive. Let's assume that you can invest $1,000 a month. If you can invest $1,000 a month, you get the same 10% return. Well, now it's going to take you 23 years to become a millionaire. And if you say, well, Jaspreet, that's still too long, well, now you want to start also working on these returns. How can you improve your returns? So let's talk about now how you can actually invest your money and different ways you can get these returns. That way you can actually put your money to work. Now I want to remind you that if you are an investor, number one, investing has risks. You're never guaranteed to make money when you invest. In fact, you will lose money at some point. So make sure you always do your own due diligence and never blindly trust a random guy on YouTube. And number 2, if you are an investor, my team at Briefs Media publishes a free daily newsletter called Market Briefs, where every day we break down what's happening in things like the economy, the housing market, the stock market, the crypto market, and the global economy into a fun, witty, and easy to read newsletter. We have hundreds of thousands of investors that read market briefs every morning. So if you have not joined yet, I get the link for you to join for free down in the description below. When most people think about investing their money in the stock market, they're thinking, how do I find the next Tesla? How do I find the next Amazon? How do I find the next Apple? You're trying to find this next hot stock. But the problem with this is that hot stock could go bankrupt. So if you invest your money into Tesla, into Amazon, into Microsoft, into Apple, whatever it is, and you do this month after month, year after year after year, and you don't know what you're doing, you don't know how to keep up with the company, and that company ends up running themselves into the ground and they go bankrupt, you lose everything. You can see why that's a problem. Now, it is more risk, more potential return, because if Tesla were to take over the world, you're going to make a lot of money. If Amazon takes over the world and you're investing in it, you can make a lot of money. If they go bankrupt, you lose everything. Higher risk, higher potential return. Earlier in this video, I talked about the S&P 500, how that's averaged a little bit over 10% a year. And the way that works is the S&P 500 is a group of the 500 largest companies in the stock market. So now, instead of just investing in one company like Tesla, you're investing in a basket of companies, which owns Tesla. It might own Amazon. It might own Apple. It might own McDonald's. It'll own this basket of companies, the 500 largest companies in the stock market. And the interesting thing about this is if one company were to start doing bad and they're no longer one of the 500 largest companies in the stock market, the fund would kick them out and replace them with a new company. For example, you might remember Sears. Sears was one of the largest companies in the world. They were a part of the S&P 500. But then when Sears started to struggle, they were kicked out of the S&P 500. So if you were investing in the S&P 500, you would have owned some Sears. But then as Sears started to go down, maybe your ownership of Sears would start going down as well, and then they would get kicked out of the S&P 500 and replaced by somebody else. So when you invest into these types of funds, you're lowering some of your risk, but also lowering some of your returns. Now you might be wondering, well, Jaspreet, how do I actually invest into something like the S&P 500? Now again, I'm not telling you what to invest in. I'm just giving you examples to help spark that investment part of your brain. But the S&P 500 is a basket, and you can invest in this basket by doing two things. Either you can go out and invest in all 500 of these companies individually, which is a lot of work, a lot of time, and now you still have to manage that portfolio. Or you can invest into a fund that gives you exposure to this S&P 500 fund. Here's a few examples of 3 different ETFs that give you exposure to the S&P 500. SPY, VOO, I'm personally invested in VOO, and IVV. These are 3 different funds created by 3 different investment institutions that all give you exposure to the S&P 500. Now, if you invest into either one of these, you're getting exposure to this group of the 500 largest companies in the stock market. When you do that, you don't have to worry about managing your portfolio per se, because the algorithm in each one of these funds is managing this portfolio. Now you might say, well, what's the difference? And the difference is, number one, it's created by different investment institutions. Number two, they might have different slight expense ratios, meaning fees, so you can compare the different fees on each one of these. And number three, they might value the companies in each fund a little bit differently. For example, all 3 of these might be investing into Tesla, Amazon, and Apple, but they might value Amazon or Tesla or Apple a little bit differently in their portfolio. So these are things that you can compare as you're making your investment decision. Again, I can't tell you what to invest in because I'm just a random guy on YouTube. My goal is to start thinking like an investor. Because for the average person who's investing their money, they're playing the game of trying to find the next hot stock without knowing how to actually analyze the stock, without knowing how to listen to an earnings call, without knowing how to read a financial statement. If you're doing all of that, well, now you're essentially just gambling because you're just hoping that the stock that you buy is going to go up. And then if you don't have the psychology to actually manage your investment, well, now you're really running a risk because the reality is markets go up and markets go down. Now, here's the thing. You don't have to go out and invest in the S&P 500. There are a lot of ways to invest your money into the broad-based economy. For example, if you just wanted to invest your money into the United States stock market, there is an ETF called VTI. This gives you exposure to the total stock market. Is again an ETF created by a company called Vanguard. This gives you exposure to the total stock market. There are ETFs that give you exposure to the Dow Jones. There are ETFs that give you exposure to the NASDAQ. These are all broad-based ETFs that give you broad exposure to the United States economy. So now what you're doing is instead of trying to find the individual company, you're just investing in the American economy, hoping that it's going to continue to grow in the future. But now let's talk about how do you actually win as an investor? How do you actually apply this? Because this is a broad depiction of what the stock market has looked like over the last number of years. And what you'll see is markets go up and markets also go down. Over the last century, we have seen 16 recessions. Over the last century, we have seen about 25 bear markets, meaning about 25 market crashes. So, markets go up, markets go down. But despite the 25 bear markets, despite the 16 recessions over the last century, the stock market has gone up by around 10% a year on average. That doesn't mean the markets always go up, but that means on average, despite the market crashes, despite the recessions, the stock market has averaged around 10% a year over the long term. And the problem is a lot of people get fixated right here into those months, maybe the years where markets are going down or where markets are kind of sideways. But the reality is the way you win is by buying here, 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 here. You get the point. This is a strategy that I call ABB. Always be buying. That's how you win as a passive investor like this. By passive investor, I mean you're investing into these broad basket ETFs. The way you win is how you keep buying. When markets go up, you keep buying when markets go down. You keep buying when markets are sideways. Always be buying means you set up a system, whether it's every week, every 2 weeks, or every month, and you just keep buying. Because what's going to happen, this will happen at some point in the future because we will see another recession, we will see another market crash. It's not a matter of if, it's just a matter of when. The next time it happens, market's going to go down like this, and people are going to panic. People are going to lose their minds. Who knows what's going to cause it? Who knows if it's going to be caused by a pandemic, if it's going to be caused by a war, if it's going to be caused by something crazy happening in the world, or maybe some sort of financial bubble crashing. We don't know what's going to be the trigger. But when it happens, people are going to lose their minds. They're going to say that the financial system is ending, that this economy as we know it could be ending, the markets are crashing, people are losing their houses, people are losing everything. Get out while you still can. People panic. That has been a reoccurring theme decade after decade after decade, every time we see a market crash. Now what happens? People get scared, they panic, they sell. Markets go down. And that creates a good buying opportunity. I like to call this POOP. P-O-O-P. Panic leads to overselling, leads to opportunity, leads to profit. Yes, I like acronyms because it makes it easy to remember. Every time you think of a recession, every time you think of markets go down, I want you to think about poop. Because those market downturns create amazing poop. And you want to find that poop opportunity because that can create an opportunity for you to come in and buy. But the way you do that in this strategy is ABB. Now, how do you actually practically make this happen? There are specific stock market brokerages out there that specialize in this type of passive investing, that specialize in this type of ABB, always be buying investing, which is where your money is automatically pulled out of your checking account and invested into your portfolio of ETFs. You can check out my links in the description to see who I'm partnered with. I personally use a brokerage called M1. Yes, they are an affiliate and sponsor for Minority Mindset, which means if you use my link down in the description, I will get compensated. But the reason why I like M1 is that they can automate this entire process, which means you can create a system every week, every 2 weeks, every month where money is pulled out of your checking account and invested into your portfolio of stocks or ETFs, and you don't have to worry about it. This way your money is automatically invested and you can set it to work. That way you don't actually have to do the work yourself to invest your money. So if you want to learn more about them, I have their link for you down in the description. But the key is just to let the markets do their thing for the long term. There will be periods where markets go down. There will be periods where markets are sideways. There will be periods where markets are booming. We don't know what's going to happen tomorrow. We don't know what's going to happen next month. We don't know what's going to happen next year. Everybody has a prediction. Everybody has a prediction, but nobody knows for sure. And that's what we have seen is that the way to win is just always be buying. Now, if you want to increase your returns, because remember, what we're talking about right now is just that 10% return and how you can get to the $1 million portfolio. If you want to get to the $1 million portfolio even faster, what can you do? Well, of course, we can't necessarily change time. This is the one factor that we can't change. We can't go back in time and start investing 10 years ago. We've talked about now how you can increase how much money you invest by working to get a raise, working to cut back on your other expenses so you have more money to invest. What we've been focused on right now is just the basic 10% return. The last thing that you can do if you want to increase how you can get to the $1 million portfolio is increasing the return on your investments. And the way you can increase the return on your investments is by working to potentially take on a little bit more risk. But it's being strategic here. Because if you go to Las Vegas and you put all the money on the blackjack table, yeah, you can get a 100% return, 1,000% return. But you're probably going to lose. Higher risk, higher potential return. But now you have to understand the game. How can you get more potential return without taking on too much additional risk? And that could be now you going out and investing into your own investor education, into your own investor research, to look for more unique investment opportunities that have more potential upside. More risk, more potential return. Maybe now you start to look at individual companies. More risk, more potential return. Maybe you go and try to find more unique investment opportunities. More risk, more potential return. There's a whole world of now different ways that you can invest your money, but just get started. The reason why so many people lose money in the markets isn't because they make a bad investment, it's because they don't invest their money. You gotta get started, you gotta be willing to lose money, you gotta be willing to go through a couple economic cycles, and then you will find the right strategy for you. You might say, I hate the idea of picking individual companies, I hate the idea of listening to earnings calls, I hate the idea of trying to value stocks and reading financial statements. I just want to ABB into the general economy. Okay, great. Maybe you say, Jaspreet, I want to be more involved. I want to read those financial statements. I want to find those more unique opportunities. That's enjoyable for me, and I like the more potential opportunity, and I can understand the risk. I understand that, yeah, I can lose all my money, but I'm willing to accept that risk. Okay, then maybe you can be more of an active investor. Again, Market Briefs is a free financial newsletter where we break down what's happening in the markets, but then we also have a more advanced Pro newsletter where we go into deeper investor research. We have a whole Marketplace Pro arm in my company where we go deeper into investor research. If that's something you're interested in, you can consider that after joining Market Briefs. But the whole idea here is understanding the game for you to build wealth. The more time your money has to grow and compound, the wealthier you will become. The faster you can double your money, the wealthier you're going to become. And the more money that you can invest, the wealthier you will become. And the wealth that you achieve, your portfolio size, is ultimately going to be a combination of these three things, and then you just got to put it into action. If you really want to build wealth and never want to stress about money again, there are 5 different types of assets that you want to buy. The problem is, if you ask the majority of people, they'll tell you to buy a random stock or cryptocurrency and hope that you get rich. And that's why most people end up losing money when they invest. But that ends today, because in this video,